Hey, it's Andy here. In our quest to learn about the markets we watch, we're always interested in new business models utilizing fintech and how that may change the market structure and market values. So part of my role here at the CFTC is to facilitate this by reaching out to, a wide range of folks to discuss what they're doing and in turn inform the public and the commission. All we're trying to do is increase the knowledge base we have to really make better decisions on our rules, regs, and procedures and anticipate what's coming down the road, hopefully. So just like we did with the FCA's Nick Cook, this will be another two-part style show as we talk with the CEO from iCapital, Lawrence Calcano. Please enjoy. Welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Just a quick reminder, there's an important disclaimer at the end of the show that's important for you to listen to. Hey, from the U.S. to China to places like Swaziland and Gibraltar, a quick thank you to everyone in the 106 countries that have downloaded the podcast. We greatly appreciate it. In my role as Chief Market Intelligence Officer, I research a wide range of market structure issues and new technologies. Now, sometimes this is groundbreaking technology like artificial intelligence. And sometimes it's, like with virtual currencies, it's a recombination of two old technologies with a new technology. And sometimes it's utilizing technology to provide access to a different market segment or a different asset class that was previously only available to large investors like pension funds and endowments. And it's this last category we're going to explore today as it's representative of how investing is changing and what technology and new ideas are being deployed. And ultimately, what this means for the risk transfer markets or derivatives. If you're giving access to a wider range of people to invest in alternative investments like hedge funds, for instance, which invest in commodities or currencies or, many of the other risk transfer contracts that are out there, then we have interest in that. Now, fortunately today, we are able to speak with a company that has been selected by Forbes as a top fintech firm in the 2018 Forbes Fintech 50 list. So joining us on the show today is CEO of iCapital Network, Lawrence Calcano. According to their website, iCapital's mission is to make high-quality private investments accessible to all qualified investors while enabling managers to reach new sources of capital. Lawrence, welcome to CFTC Talks.
Thanks, Andy. It's a pleasure to be here.
Hey, before we get to iCapital, I want to get some basics down first for the audience. A conventional investment is like an asset like stocks or bonds or cash, but alternative investments or private investments are different. Please explain that.
Sure. At the end of the day, the investments are providing, similar purposes for the companies and for investors, but they're structurally different. So, stocks and the bonds of some of the high quality companies, a lot of those are publicly traded, and there's pretty ready liquidity for those types of instruments. Private equity, private credit, et cetera, those tend to be illiquid. The purpose of the investment is the same. It's to give money to companies that are growing businesses, that are building businesses. Often that is in the form of equity. Sometimes that's in the form of debt. And so while, just like when you invest in a common stock, you're obviously as an investor looking to generate return, the company uses the money they raised in common stock offerings to grow their business, to acquire businesses, et cetera. And so it's a very similar purpose for the company. And, it's a similar purpose in a sense for investors, that they're investing in companies they believe in and that they hope to generate a profit on those investments. So they're very similar for both parties, but clearly, there are some structural differences between the products, which frankly make some private investments, not appropriate for certain investors.
Right, and I guess alternative investments as well, they're only available or have been in the past to large investors or really folks with like $5 million plus. Well, why is that? Well, why do they put that number out there?
Well, look, I think in some cases, by the way, it's higher than that, 10 and 20 million.
Okay.
And so, but your point's exactly right, which is, when you have investments that have such high minimums, and as I mentioned a second ago, they're illiquid, it makes it really a relevant asset class for really only for certain types of investors like pension funds, as you mentioned in your introduction. In addition, these investments tend to be somewhat operationally complex. And so, things like completing the subdocs or the subscription documents, they're very, long and dense documents. The asset class, when you invest in the asset class, you tend to put up only a small amount of the money up front, and then as the general partner or the sponsor of the private equity fund, they'll call down capital over time that you'll continue to make. And so there's an operational element to investing in these asset classes. And when you take all these things together, it's really made the asset class most appropriate to the large pension funds or foundations and endowments. And by the way, in many of those cases, the illiquidity is actually suited for them because, in most pension funds, they're dealing with trying to fund long-term liabilities or obligations. And so the illiquidity and the fact that these investments might compound over 3, 5, 7, 10 years is actually consistent with what they're trying to accomplish. So while for certain people that illiquidity might be a challenge, for some of the large institutions, it's exactly the type of investment they're looking to make.
Yeah, I mean, obviously they have the resources to be able to deal with the complexity of what the asset class needs, right, or requires. And I think that's a challenge, obviously, for them, but also for anybody who wanted to do it themselves, even if you had $5 or $10 million. But let me segue into iCapital. What have been the big roadblocks for most investors when it comes to alts? I guess you kind of detailed it a little bit, the complexity of it. I think it's always interesting to me when I see a company like yours. What problem are you trying to solve for people, I guess, is the question.
Sure. Well, what we're doing really as a company is building a bridge, building the infrastructure that connects, high-quality general partners, i.e. the general partners of the funds that look for companies to invest in, with high-net-worth advisors that, are out trying to create portfolios that make sense and are suitable for their clients. And so we've built that bridge, and a lot of what we're doing is actually tackling those impediments I just mentioned. So, getting high net worth advisors access to funds that historically they just haven't had access to, allowing them to invest in minimums, not the $5 and $10 million minimums, but in fact as low as $50,000 or $100,000, so that they can employ client capital in a really thoughtful and diversified way. If all you could do is buy one private equity fund, I think portfolio construction theory might suggest that's not the right way to do it, as compared to actually being able to invest in many different funds so that you can actually build out diversification in your private portfolio, just the same way you would think about building in your public portfolio. And so we reduce the minimums, allowing people to be able to invest in a thoughtful way. We provide very robust due diligence for them, and a lot of times the advisors don't have access to that kind of deep diligence information. So we'll provide that, make it available to them to think about, how does a certain private equity fund or hedge fund fit into a portfolio, and why is one fund, sort of better than another. And then importantly, and this is really where, a lot of the technology comes in, we'll take that operational complexity and really simplify it. And everything from how we present the fund to an advisor and then the client, and how they subscribe and actually make the investment or the transaction processing, and then importantly, how we manage the life of the fund beyond that subscription. As I mentioned earlier, one of the big differences between common stock is you put all your money into the stock day one, whereas with private equity, you'll fund a little bit up front, but then there are capital calls that you're required to make over time as the underlying general partner finds new investments. And so we manage that process for the advisor and the investor as well. And so all of the sort of the roadblocks that have made this asset class pretty challenging for high net worth investors, we've broken down through use of our technology and our service and operations model.
Yeah, that's interesting because I think a lot of times people look at technology or fintech and they look at these, what's in the headlines, the really sexy stuff, but there's some fascinating things going on really in the piping of the system. And this is, I think, an interesting example of where what you're doing is you're utilizing the technology that you have to make it easier for people to access these types of asset classes, to make it simpler for them, smaller minimums, and leveling the playing field a little bit on that. And to me, that's fascinating, but it really begs the question is that because it's so much more complex, I mean, how much time do you spend educating your the people that are using this platform?
So that's a huge question, and the answer is quite a lot. You kind of hit the nail on the head when you talk about the complexity and so forth. There are just different features of this asset class. The fact that you have capital calls, the fact that you've got distributions that come in over time, the way in which these products are reported on is actually quite different. And so we spend a lot of time, in the advisory community, educating people on how the asset class actually works, how it fits into a portfolio. We've actually created some partnerships with some of the leading educational institutions and certification institutions in the marketplace, like Akaya, and we've really spent a lot of time on this. And frankly, when I think about our advisor base, there's definitely some advisors there that are very sophisticated. They've been investing in the asset class. They have wealthier clients that really want to have this as part of their portfolio. Down to maybe some other advisors for whom this asset class is newer. And so in that case, it takes a lot of time. And, I would say that it's gratifying that a lot of the advisors we work with are very thoughtful, and they want to make sure that, they really understand the asset class before they go and recommend to their clients that it makes sense in their portfolio. And so in many cases, we might spend, a year plus really not talking about funds in particular, but just talking about the asset class, how it works, where it makes sense, where it doesn't make sense, what types of clients it works for, and so forth. And I think when you go through that process, you end up with people making better decisions, right? They invest in things that really make sense for their portfolios, for the types of exposures they want to have, and I think that's the right way, frankly, for us to be building our business. It takes longer to build, but when you build it, it's a much stronger business as a result.
Yeah, that makes a lot of sense. And I guess it someone begs the additional question is like, what is driven, in your estimation, what's driven the interest in this movement towards alternatives in the investing ecospace?
I think a lot of it has to do with some of the basic reasons people want to invest, right? They want to earn returns. And I think, if you look back over time and, look at a firm like Cambridge, which is a big consulting firm in the space that studies returns, I think you'd see that, private equity over whether it's 5, 10, 15, or 20-year periods, has provided net of the fees a higher return than a basket of public stocks. And so I think, first and foremost, people invest in the asset class to get higher returns. And we've seen that both on the private equity side, also on the private credit side. As you know, that over the last several years, with interest rates being so low, it's been very difficult for people, to generate much in the way of return on their fixed income portfolio.
Right.
So for those types of folks, private credit, and similar structures, can help them generate more return even in that part of their portfolio. And so I think those are two very big areas. And I'd actually add diversification is another important element in terms of as people think about constructing a portfolio and creating diversification, whether it's through private equity or hedge funds. That's another big driver. And I'll mention one other thing which I think will surprise maybe a lot of your listeners, which is, it's it's very difficult. If you look at the public markets, I mean, over the years, the number of public companies has really shrunk.
Yeah.
So I think now there are maybe 5,000 public companies, and within that mix, there's not a large number of public companies that are actually really generating a lot of growth. And what happens is, because of a relatively small investment universe, you end up with firms like they're affectionately called the FANG stocks, but the Facebook and Amazon or Netflix and Google, add Apple, the companies that are really growing, they tend to get a lot of interest by large institutions as well as high net worth investors, and those stocks start to get very expensive, or at least they go up. I won't comment on valuation, but the number of opportunities to invest in growth companies in the public markets is somewhat constrained, whereas, by comparison, if you looked at the private market, there's something on the order of 100,000+ private companies with EBITDA, those are sort of earnings before interest, taxes, and depreciation, in excess of $25 million. And so if you want to build a growth portfolio, the private markets actually really afford you the opportunity to invest in companies that are truly growing and in many cases are not correlated with the market. So that's another driver for people, particularly those more experienced investors in this space. They look at the private markets as a big opportunity to add growth to their portfolios.
I think that's one of the more interesting development that's happened recently is the shrinkage of the public markets, and why that's occurred. Obviously, you can point to a number of different reasons, but that's why I think what's interesting in what your company does is it opens up the private markets to capital to flow into them, and ultimately, as a capitalist system, that's what we need to have: efficient capital flow to the people that need it to grow companies, to create jobs, right? And so that's really interesting from a number of standpoints, and I think is encouraging. But let me ask you this: so we've talked about alternative investments and where people. What does iCapital look at? Like, what are your metrics for making these investments? Do you have like certain groups that you like to invest in? How does that play out? Like, what is the sandbox you play in? And just one more question on top of that. I just want to be really clear. Your role in aggregating capital is really to be a limited partner, correct? To meet the minimum requirement for these PE and hedge funds.
That's correct. We aggregate. Okay. So when we talk about taking capital from high net worth investors, we take that capital into a pool, we aggregate that, and then put all that money in either the fund or funds that are part of the investment vehicle. So we are both GP to our high net worth investors. At the same time, we are LP to the underlying general partner, the underlying investment firm.
Okay.
And
great.
So we aggregate that and send them one ticket.
Okay, that makes perfect sense.
Yeah, so in relation to your question or response to your question, we're really trying to cover the waterfront in terms of strategies, right? So I mentioned before the objective of allowing people to create a diversified portfolio. Well, that includes being able to create a diversity of strategies, right? So, a lot of times people think about private equity as being one thing, like buyouts, or maybe they think about venture capital. To us, it's the full gamut of buyouts. And by the way, buyouts come in many flavors. They could be mega buyouts, they could be mid-sized buyouts, or they could be small buyouts of, small local companies that are, $20, $30, $40, $50 million. And so we work across that spectrum. And then growth, I've already mentioned, that's obviously an important part of the mix of investment choices we provide. Distressed companies that are in distress, there are a number of general partners in the marketplace that are focused on these kinds of situations. Venture capital obviously is an important one, and then credit, lots of different flavors of credit investing, some of which are more direct lending, and those would be more higher quality credits to firms that invest in sort of lower quality or lower parts of the capital structure, which have more risk and as a result higher return, typically speaking. And so we provide the full gamut of investment strategies, and the same is true with hedge. Across the different strategies within the hedge fund universe will allow people to create a really diversified portfolio. And so providing that one of the really critical things, and a lot of advisors look to us for this, is they're looking to us to really provide that institutional quality due diligence, and that's really critical. So, when you ask about, how do we think about putting funds on the platform, well, yes, it's about what are the strategies we think are important, but it's also what are the managers we think are have a track record, a history, an operating style, a team that taken together, give us a high level of conviction that they will be able to produce, the types of returns that they're targeting, for investors. And obviously those types of returns are going to vary based on the investment strategy, but we'll provide, a fully institutional or consultant-like due diligence process, and then we'll prepare a written report and make that available for our high net worth advisors and investors to see. And that's a very rigorous process, and it includes obviously substantial number of meetings with the manager. Right. It also includes discussions with portfolio company CEOs and other executives, with other LPs, and a fair bit of referencing on the managers as well. And obviously, just like with common stocks and bonds, there's no such thing as a guaranteed profit, and so we can't we don't take the position that people are going to invest in these asset classes and get guaranteed returns. These are, as with all investing, risky investments. But the key is that we do a ton of work up front to try to have a high level of conviction that the strategies and the managers on the platform have a high likelihood of delivering the types of returns that they're indicating.
Okay, that's part one of our two-part series on alternative investments with iCapital CEO Lawrence Calcano. Next week, we'll put out part two. I'm Andy Bush, CMIO for the CFTC. Thanks for listening. This has been CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.